Hi and welcome to Talk with CA. This is CA Arvind, and today I'm going to share you very important key indicators or ratios which will help you to assess company's financial health. So if you are an investor or any other person who want to know the company's financial health, then this video may help you to some extent. So let's begin this video. So let's have a look to the company's key stakeholders which are directly or indirectly associated with a company, which includes the investors who invest in the company, the lenders who lend money to the company, the customers who buy services, goods of a company, the supplier who supply goods or services to the company, the employees who work for the company, and the government. So all these stakeholders are associated with the company directly or indirectly, hence they should have a clear idea about the company's financial health. So in this video, we will be discussing very important financial metrics or key parameters which will help you to get some idea about the company's financial health. So these are the basic bare minimum key parameters or ratios which help you to judge the overall company's performance and associated risk. A company is said to be viable if it is a profitable, liquid, solvent, and efficient. So let's move on and understand how you can test these ratios by following simple steps. I'll cover only few main ratios which certainly help you to get some idea about the company's financial health. So let's get started. So first we'll talk about the liquidity of a company by knowing the liquidity ratios. These ratio talks about an enterprise ability to pay its short-term obligation. It also covers company's operating cycle and short-term solvency. So one of the most commonly used short-term liquidity ratio is current ratio, which simply compare company's current asset with the current liabilities. Current asset are those assets which are expected to be converted into cash within a period of 1 year, whereas current liability includes the obligation which are expected to be paid within period of 1 year. Current asset includes the cash and cash equivalents, the accounts receivables, the inventories and other current assets, whereas current liability includes the account payable, the statutory repayments, short-term loans and other. So let's understand the current ratio with the help of this example. I'm comparing company A with company B and assuming that both companies work under the same sector or industry. So company A having a current asset of 2000 crores, whereas its current liability stood at 1000 crores. So it has current ratio of 2. That means for every 1 rupee of liability, company A has 2 rupees of current assets. Whereas company B having a current asset of 300 crores, whereas its current liability stood at 500 crores. That means it has current ratio of 0.6. For every 1 rupee of current liability, company B has 60 paisa of current assets. So it looks like company A is managing its working capital efficiently or maintaining its short-term solvency perfectly, whereas company B looks still struggling to meet its short-term solvency. So one of the biggest disadvantage of current ratio is that it does not speak about the quality of current asset. So apparently it looks that company A better than company B, but it may be possible that company A locking up its fund in account receivable or inventory or any other short-term or any other current asset for longer period of time. So you need to check the quality of current asset before you give your final conclusion on current ratio of a company. So let's talk about the profitability ratios of the company and how you can judge the company's performance with respect to it. So it shows or it indicates an enterprise ability to generate profit relative to revenue or assets. तो रेवेन्यू और असेट के अगेंस्ट में कंपनी ने कितना प्रॉफिट जनरेट किया उसको ये रेशियोज इंडिकेट करते हैं. सो मोस्ट कॉमनली यूज्ड प्रॉफिटेबिलिटी रेशियोज आर ग्रॉस मार्जिन एंड नेट मार्जिन रेशियोज. For gross margin ratios, you need to have a two component from your financial statement of a company for a period under review, that is net sales and COGS, cost of goods sold. Cost of goods sold means the cost of raw material plus cost of conversion or direct cost of manufacturing. It does not include the indirect cost of manufacturing. For net margin ratios, you need to have a PAT, profit after tax, that you will compare with your net sales. So when you will divide your PAT with your net sales, you will get net margin ratio. So let's understand this with an example. So I'm comparing the company A with company B. So company A's net sales is 1000 crores. However, its COGS, the cost of goods sold, is 750 crores. Its gross margin is 250 crores, which is 25% of sales. Whereas company B, having a turnover of 500 crores as against its cost of goods sold of 300 crores. It having a gross margin of 200 crores, which is 40% of sales. That means company B is having 40% gross margin, which is at a better position as compared to company A, which is having 25% gross margin. So it may be possible that company B is enjoying good margin because of lower cost of goods sold or better markup. यानी कंपनी अपने खर्चों को कम करके या अपने मार्कअप को बढ़ाकर वो ग्रॉस मार्जिन रेशियो को मेंटेन कर सकती है. So till now we have talked about the short-term solvency and profitability of a company. Now we will assess the efficiency of a company by knowing the efficiency ratios. These ratios talks about an enterprise ability to utilize its fixed asset to generate revenue. That means it reveals how efficient a company is at generating sales from its fixed asset. The most commonly used ratio is fixed asset turnover ratio. Here you need to know two components, that is fixed asset and the turnover. When you divide your net sales by average fixed asset, you will get fixed asset turnover ratio. Higher the ratio, better is the position of a company with respect to its efficiency in utilizing its fixed asset. So let's understand this with an example. Company A having a net sales of 1000 crores as against its fixed asset of 1500 crores. That means it has a FAT, that is fixed asset turnover, is 0.67. However, company B is having a net sales of 500 crore as against its fixed asset of 600 crores with a FAT of 0.83. That means company B is performing well or showing a greater efficiency in managing its fixed asset or investment. यानी कि कंपनी B अच्छा परफॉर्म कर पा रही है कंपनी A के अगेंस्ट में, क्योंकि वो अपनी फिक्स एसेट को अच्छे से यूटिलाइज कर पा रही है अपनी सेल्स को जनरेट करने में. ऑन अदर हैंड, कंपनी A low fixed asset turnover ratio indicates that company is not using its asset to its fullest extent. तो चलिए अब बात कर लेते हैं लॉन्ग टर्म सॉल्वेंसी रेशियोज की. So it talks about an enterprise ability to meet its long-term obligations. So most commonly used long-term solvency ratio is debt to equity ratio, which compare the company's external debt to its equities or reserves. Higher the debt equity ratio indicates the lower solvency of a business. That means अगर एक कंपनी के अंदर एक्सटर्नल डेट ज़्यादा है एज कंपेयर टू इट्स इक्विटी एंड रिजर्व, देन इट इज अ थ्रेट ऑफ इंसॉल्वेंसी. So let's understand this with an example. Here we are comparing company A with company B, assuming that both the companies are under the same industry or sector. So company A having an external debt of 2000 crores as against its shareholder fund of 1000 crores. That means its debt equity ratio is 2. For every 1 rupee of shareholder fund, company A has 2 rupees of external debt, which is not a good sign. However, company B having a external debt of 500 crores as against its shareholder fund of 1500 crores. That means for every 1 rupee of shareholder fund, company B having only 0.34 external debt. That means company B is at a good position. So a lower debt equity ratio implies a more financially stable business. Company with a higher debt equity ratio are considered more risky to the creditor or investor than a company with a lower ratios. यानी जिस कंपनी के एक्सटर्नल डेट ज़्यादा होंगे एज कम्पेयर टू इट्स शेयर होल्डर फंड्स और रिजर्व्स, वो कंपनी ज़्यादा स्टेबल या ज़्यादा फाइनेंशियली स्टेबल नहीं होगी. So there are other non-financial factors which also affect the company's financial health, which I'll try to cover up in next or upcoming videos. I hope you like this video. So if you have any questions, you can drop the same in the comment box. I'll definitely try to answer them. Thank you so much for watching. Stay connected.